Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Jack Miller, Head of Global Execution Services at Baird, to discuss liquidity, the role of the retail investor, and the shift to T+1 settlement. Jack, it's great to see you as always. Welcome back to Trade Talks.
Thanks for having me, Jill.
And here we are already in March of 2022. What are the topics that have dominated conversations with clients so far this year?
Yeah, well, obviously the conversations have been dominated by the macro environment. We have inflation at 40-year highs, soaring energy prices, gasoline at record highs, a very uncertain path forward for the Fed, and tragically, we have war in Ukraine. And the result of all this is the highest volatility that we've seen in a year. And certainly that's something that's continuing as we speak today. So in some ways, a lot of the market structure topics that we've been talking about have not been quite as top of mind recently in the dialogue. But that said, as traders, our clients are faced with the same primarily challenge they always have, which is finding liquidity. And that's fundamentally our job as brokers to help them navigate a fragmented marketplace, either through our own upstairs block liquidity or through interactions on exchanges or other trading venues so that they can implement their portfolio decisions in an efficient and cost-effective way.
Over the past year, we spent a lot of time talking about retail investors and their growing influence in the marketplace. How has that trend been playing out this year?
Yeah, so one of the observations we talked about the last time that we were together is that we hadn't seen a period of sustained volatility in the last year, or maybe I should say a market correction or an extended drawdown. And we wondered how or if that would affect retail participation that had really surged in the last year. And it looks like it has, at least relative to last year. So some of the proxies we look at to measure this is the amount of off-market trading. So we know that most retail activity occurs off exchange. That's, of course, something that Nasdaq and other exchanges have tried to address. But we've seen that level of off exchange trading come down well off the peaks that we saw last year and over the last month or so, really below 40%, which is a level that we haven't seen since the beginning of the pandemic. Another proxy we look at is sort of when in the day are we seeing trading volumes. So retail tends to be a little bit more bunched towards the open, with institutional activity really bunching up at the close. And so that too, relative to last year, we've seen a bit of a shifting in the curve during the trading day, more towards an institutional profile relative to retail. So to the extent that we've seen new participants come into the market in the last year, it does appear that they may have retreated a little bit, still a force, or maybe they're focused on other things, other asset classes, in the process. One thing I would like to observe, though, and kind of regardless of this, and I think one of the areas of impact we've seen from the rise of retail is really helping to set the regulatory agenda. So pulling back towards, some of these equities-focused topics, whether it's payment for order flow, short sale disclosure rules, or even something like fractional share trading.
Right. And to that end, the SEC last month announced a shift to T+1 settlement and actively asked the question about what it would take to move to same-day settlement. Are there any challenges or unexpected consequences that you potentially see with this?
Yeah, so this is a direct, catalyst, of the meme stock movement. Even if it's something that was somewhat of an eventuality, something widely anticipated, largely uncontroversial, even welcomed by many market participants, this should have the impact of reducing systematic counterparty risk in the system. I don't want to underplay it, but operationally as an industry, this is something we've done before in the not too distant past. We just moved from T3 to T2 in 2017. And although the next step, I guess I would say, moving to T0, which is something that's contemplated in the announcement, is going to raise more challenges that are going to require a more drastic redesign of some of the core operational processes. The main thing being the loss of kind of an overnight processing cycle, dealing with global time zones and things like that. So, really, I think tying this back to the retail side, the whole idea of the settlement cycle and clearing deposits is something that got a lot of attention when clearing deposits were cited as a rationale for some brokers needing to suspend or limit their activities back in the height of meme stock mania. And this surprised, it concerned a lot of investors who are not just concerned about their ability to trade, but are also coming in with a set of consumer expectations about how markets ought to operate. And they don't necessarily share some of the assumptions that those of us who've been exposed to securities operations over the years have kind of taken for granted. So in their mind, they saw some of these aspects as a little bit antiquated. So I think there's something interesting to watch coming out of this as a broader trend, is what is going to be the influence of consumer expectations on market structure. This expectation that trading should be anytime, anywhere, settled immediately, and by the way, free, which all sounds great, but I think is ironically a little bit counter to some of the institutional preferences. We see large buyers and sellers who are often looking for less fragmentation, not just in place, but in time, which is why we've seen this increased importance around kind of liquidity events like the close.
Right.
So on one hand, this could really be a catalyst to modernize the plumbing of our markets, but on the other hand, could also ironically drive further segmentation between the needs of retail and institutional communities, which largely already exist in parallel market structures.
All great points, Jack. Great to catch up with you as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you.